Now, you're waiting for me to say Monday the 31st, but you know what? I'm on to you people. It's Tuesday, the 31st of May. Tomorrow's June. The symbol for June is M. We'll talk about that in the days to come. 1 p.m. Eastern Time. Swizz here, you there. Dan Nathan joining me always. And oh, by the way, in just a few minutes, Carter Worth of Worth Charting will be on as well because we need him today. Today's market call brought to you by CME Group, Dan, where risk meets opportunity. And of course, we're powered by Open Exchange. Check them out on Twitter at Open Exchange TV. I hope you had a great long weekend. I know I did. Quickly, I'll tell you in order. The New York Ranger game at home, that would be game 6, Saturday evening, a win. Sunday was Top Gun with my wife and one of my kids. And then obviously last night, the Rangers of New York took care of business in Carolina. Eastern Conference Finals tomorrow at Madison Square Garden. How are you, Dan?
Yeah, dude, I was fired up for you. I know you were at the game Saturday night. I know you were watching last night on TV. And to win the way they did on 2 Game 7s in a row, Guy, what is your scouting report? Will this series with Tampa also go 7? And will June 14th have a home Series 7 to go to the Stanley Cup?
I like what you're doing there. The Rangers do have home ice advantage, oddly enough. Tampa, 2-time defending Stanley Cup champs. The difference in this series will be goaltending. As good as Igor Shesterkin has been, the goaltender for the Tampa Bay Lightning has been equally good. We will see how this plays out, but people aren't tuning in for that, Dan. They're tuning in to find out what the frick is going on with these markets.
Matter of fact,
we had a bit of a sell-off today. Market bouncing back. We'll see if it holds. A lot to talk about, though, Dan Nathan.
Yeah, so I thought these 2 competing headlines were really good. Amanda Diaz, obviously, just kind of going,
producer.
just going above and beyond here a little bit. You wake up and there's 2 competing stories, right? It's this first one. We know oil has been trading up all weekend. We know the EU ban of oil was coming, and we see crude, and we're going to go into much greater detail with Carter when he comes on in a few minutes on this one. But again, what does higher crude oil prices do? It means you're going to have pesky and more persistent inflation, as you like to say, Guy, on one side, right, which kind of really gives the Fed all the cover that they need to do to keep raising interest rates. On the flip side of that, we've seen this headline out of Foxconn. Basically, this is the largest manufacturer of Apple iPhones in China, maybe saying that these lockdowns and some of the supply constraints that they've had aren't as bad. We know that Apple had already guided down. They said specifically something about China in particular. So these 2 competing headlines are kind of interesting, Guy, and I really do think this is going to be the push and pull in the markets over the next few months.
Supply chains are extraordinarily important. We've been talking about them seemingly for 2 years. I don't think we ever talked about supply chains in the 14 and a half or so years prior on Fast Money. Now it's seemingly a weekly conversation, and understandably so. And listen, it was just a matter of time. You've been saying it for a while. You didn't think the supply chain problem would last forever, and it's seemingly starting to abate. Anecdotal, I get it, but at least it's a good sign without question. And this is not me just talking my book or usually my negative bias or whatever it is, but crude oil to me or energy sort of trumps all of that. Supply chains are important, but energy is still the thing that drives everything. And crude oil has been both pesky and persistent. It had every opportunity to break down. We will talk to Carter. It did not. Now it's bouncing. And again, the Fed is doing everything it can to tamp down inflation. The problem is crude oil didn't get the memo, Dan.
Yeah, well, you and I, we threw this chart up here a couple weeks ago, and, we're just saying how it's really held that uptrend since those early December lows. We know what happened then. That's when the Fed pivoted. The Biden administration tapped that strategic petroleum reserve, and since then it's been, bottom left, upper right, nice 45-degree angle. And here we are. We're trading about 2-month highs here. Let's see if we can hold. To us, this is just kind of one input here about the whole story. But I guess what I would say, Guy, on the supply chain stuff, though, is that if that is abating, I believe that you're also going to see the sort of weird supply-demand dynamics in energy, and that's likely to abate also. But who knows, man? I mean, in the meantime, they could kind of cancel each other out, and that's probably what we're faced. And that crude oil chart, I mean, you thought it was a blow-off top in early March. It was. it's settled, but here we are. It looks like we're kind of poised to retest. You also said the same thing about rates here, okay? And you thought that we'd see a flight to quality as growth fears kind of make their way through the markets, and you thought that people would be buying treasuries, thus having yields come in. They did, but I do think it's interesting, Guy, when you look at this 10-year and you look at the move today, it's basically saying that it's giving the Fed more cover, right? What's going on in the energy markets to continue to raise at the pace in which they want, at least that they suggested they're going to do over the course of the summer.
Yeah, and I lost you for a bit there. I'm sorry, Dan. I seem to but
yeah.
That's what you just said. I mean, in terms of the growth fears and all those things, I'll say this. I think one of the reasons the market's been rallying over the last week or so, oddly enough, somewhat counterintuitive, is because the data's been sort of soft. And I think what the market is trying to glean from that is maybe the Fed doesn't have to be as aggressive as they've stated that they will be. And maybe this softening data will take the Fed, take their foot off the gas pedal, and rates won't go as high as abruptly and those types of things. I think that's somewhat misguided, but I think that's what we're in the midst of now. In terms of yields, I think that's exactly what we're saying as well, that yields obviously traded north of 3%, significantly so in the 10-year, pulled back, yes, in a form of a flight to quality, but also in the form that maybe things are slowing. So in both cases, yields going lower, again, just my opinion, is not a positive sign.
No, I agree with that. Let's look real quickly at the trusty CME FedWatch tool here. That's basically saying, a very high probability by the July meeting that Fed funds rate's going to be at that 2% upper bound, Guy. And so that's the thing. You're just going to keep watching the data to see if there's any reason why the Fed should pull back on it. That seems to be a pillar of the bull case. But one of the things that you highlighted, this HYG, this high yield ETF, right, that tracks high yield bonds. And one of the things that you've been highlighting over the last few months or so is that it's been trending lower. In the last couple instances, it got to 80 or below. We definitely had some instances where there was fear of some sort of credit moment, right? And that would have been the thing that could have gotten, I think, the equity market going much lower. You highlighted last week that the silver lining was that the HYG, or at least what was going on with credit, looked like it was trying to make a bottom here. And not only did it look like it bounced off 76, it went in a straight line to 80 and got rejected. Now, on a percentage basis, maybe that's not a huge move, but I think directionally, you think that's kind of important.
No, it's very important. And listen, for most things, it's not a huge move. For this instrument specifically, or security, is a huge move in terms of the HYG. Something that historically doesn't move, was sort of sitting around 88 for the longest time, obviously sold off. And I think at least we were early to the dance to try to point out that, hey, folks, you might want to take a look at this. This seems to be starting to roll over. What I took from last week, and I'm glad you pointed it out, was the fact that although the market was under pressure, the HYG wasn't. The HYG was actually holding in there, and I took that as sort of an encouraging sign. Subsequently, it seems like the broader market rallied, and HYG did that as well. I think a lot of it is short covering, is my sense. Again, I think a lot of it's predicated on maybe the fact that the Fed is not going to be as aggressive as everybody thinks they're going to be. Again, just my opinion. I think that's all going to be short-lived and somewhat misguided, and we'll see. But if the HYG starts to roll over again, which it appears to be doing, to your point, that's no bueno, as they say. No bueno.
But Guy, one of the things that's really nice about you and me just kind of putting on screens like this and talking to each other each day on Market Call and doing it on our podcast, doing it on CNBC's Fast Money a few nights a week is that we're kind of on the record every day about what's going on with markets. And I think that, we highlight this every once in a while. Some people like to label us as, perma bears or whatever. I think we got incrementally more constructive. This is not me trying to pat ourselves on the back over the last couple of weeks. We just thought that sentiment was getting really bad. Things were getting very oversold. And it looked like there was at least some near-term trading opportunities. But one of the things I think is really important is timeframes when you're thinking about markets, when you think about trading versus investing, that sort of thing. And so we had Mike Wilson. He's the CIO and market strategist at Morgan Stanley. He comes on CNBC a lot. He was on our podcast on Friday. You and I spoke with him for more than a half an hour and got into his kind of call. He's been pretty cautious on the stock market since the fall here, and he's been right. And we had a great conversation with him. He's out with a note this morning saying, it's not all clear yet, people. And again, some things might have gotten really oversold, overdone to the downside. But structurally, with the S&P, Guy, right now, as I'm staring at my screens, down less than 13% of the year. all of what's happened, okay, the correction for, a year and a half or multiple years of kind of some very bad investment, if you will, is not going to be encapsulated in a 20% peak to trough decline. In my opinion, he's saying we're not clear yet. Look at this 1-year chart of the S&P futures. You see the 150-day up there at 4450, Guy. You see where we got rejected earlier today at 4200. What's your take on the S&P here?
And the S&P, the 150-day moving Carter Worth will be joining us in a few minutes, and that will not listen. That is rolling over, and that is officially now headed lower, and that takes a long time to turn the other way. So, in my opinion, again, just my opinion, the worm turned in November. Obviously, we've been in this down market. We've seen significant bounces along the way. That's what we're in the midst of now. But I agree with Mike Wilson, and you think about for somebody like Mike. And it's easy just to be bullish all the time and have basically no repercussions for being wrong if the market goes down. He's putting it out there now, and I appreciate that. I agree with you. The difference now between years past is, again, my opinion, there's no backstop. At least there's no backstop within 10 to 15%. Maybe the Fed lives, and maybe it lives around 3,400 or so, but it certainly doesn't live at 4,000, and I don't think it lives at 30.
Yeah, no, I agree with that, Guy. You're breaking up a little bit, so when you kind of pop out, I'm going to pop in here. And I guess one of the things that I would say about that is easy to kind of say, well, that's it. Things got overdone. We're starting to get some headlines where inflation's peaking, supply chain's getting better, all that sort of stuff. Who knows? But I'm just not a buyer of things that I want to do for an intermediate to a longer term basis after the sort of week that we've had. I want to buy things when it looks really bad, if you will. And if you look at the NASDAQ here and you see that kind of 150-day, also at like 14, this is the NASDAQ futures, the NASDAQ 100 futures, 14,671, and you see that 13,000 kind of breakdown level. I mean, kind of an important level that it was not able to even retest. You see how steep that downtrend has been. Let's see how the NASDAQ futures are trading at 12,000 if they get back there in the near future. And then the last thing I just wanted to hit before we get to Carter, on Salesforce.com is reporting after the close tonight about $15 implied move in either direction. That's tomorrow, Guy. That's about 8%. You see that downtrend. I connected the two big dots. It gets you to about 180. That's also the breakdown level from earlier in April. Any thoughts here? Because this is a stock that at its lows was down, cut in half nearly. A company that's a bit of a roll-up now, I think, on a GAAP basis, on an EPS basis. Still pretty expensive, trading about 30 times. Expected sales growth about 20%. But again, they've been buying companies over the last few years or so, trading just below 5 times sales. Thoughts here on Salesforce into the print here, because it really hasn't had a huge rally off those recent lows.
No. For you playing bingo, if you have temerity, here you go. Because if you have the temerity to get involved here, I think it actually can bounce to that 180 level, which would still put us in a downtrend. And 180 from here is about, Dan, and you can do that math, it's about an 11% or so move. I think that sort of makes sense. We'll still be in a downtrend. It'll still be problematic on valuation, but you might get sort of this knee-jerk rally, this relief rally that we've seen in a number of different names. So I actually think, again, my opinion, you can buy Salesforce for a bounce post-earnings, but you get out of it quick, especially if it trades up to that trend line, which should come in, to your point, around 180 or thereabouts.
Yeah, I would just say that to what I'm focused on here, Guy, is to see that if the quarter looks pretty good and the guidance is not bad, if the stock can rally, if it could get up anywhere near that kind of 8% implied move, and then whether that rally could stick. On the flip side of that, if they were to guide down, it really would be the sort of situation where if it's not a big guide down and the stock's down so much already, does it kind of just not get nailed is really the question here. So this will be really kind of interesting. I don't think anyone needs to have a whole heck of a lot of temerity, whatever that means, in front of the print, though, I'll tell you that.
Look it up. It's a great word. Am I allowed to do this? Because I love this part of the show.
Yeah.
This is the part where we get infinitely smarter and extraordinarily sexier when I bring in the great Carter Braxton Worth of Worth Charting. Carter, how are you? You've heard Dan and I opine for the last 15 minutes.
I gotta say,
thoughts?
I don't get greetings like this anywhere. Not at home, not at the office. I mean, genius, sexy. I mean, God bless you.
Well, it's all true. I mean, I speak the truth. You heard us
opine. More and more, please. Yes. I mean, market, look, it's another counter trend. How long it lasts, we don't know, but there have been two, and this is the third. We made our first 10% plus sell-off, market peaks Jan 4, and on January 24th, a big rally ensues, 9%. And we make a new low 1 month later, Feb 24, and we get a 12% rally. And then we make a new low May 20, and then we've had a bounce. This bounce is 8, 9%. I think it carries a little further. Independent of whether one is bearish or bullish, bull market, bear market, the sequencing, this bounce is normal or normative. It's in line with the others, and I think it's got a bit more to go. And to be frank, look at today. Even today, it's weak, and then it shakes it off. I think we go higher a bit.
The word I use. Oh, I'm sorry, Dan. Go ahead.
Yeah, no, I was just going to say that, again, Carter was calling for this. We had this sort of move here, and none of us are going to kind of nail the exact bottom here. I think you were kind of a day early. We had one more nasty day, but we are well above those lows in which you called it here. And do you think it's fair to say, Carter, I don't know if you heard me say earlier that, the S&P down 13%, given all the uncertainty we have as we head into the third month of the second quarter, it just doesn't seem that right. So I'd love for this thing to get a little frothier in the next couple of days, and then we see how quickly it takes us, or what are the headlines that cause us to retest those recent lows.
Right, or just think about if you took the line, maybe we have an S&P chart here we can pull up, but the one you had before. If we look at the bounce, instead of having it a bounce, put it as a decline. If we'd gone down another 9% instead of bouncing right then, if that entire pullback there bounce were the exact opposite, we drop from 38 to 35 or 34, we would be getting done with it. But it's the bounce that keeps essentially the bear market alive. It means that money keeps being put in. Usually it's not finished until no one wants to do it anymore. They're like, I'm tired of this. I don't want to do it. Clearly, people are still interested.
Clearly, they are. All right, here's the deal, Carter. Let's talk about this. You saw that crude chart that we threw up there. We didn't want to go too deep into commodities here. The energy sector here, we're breaking out of this kind of multi-month range here in crude. You saw the headlines. Talk us through a little bit about this, because it seems like this is a very consensus trade now that everyone wants to be kind of long crude oil or long the energy complex. I do think it's interesting, though, that I saw like Goldman Sachs today downgraded steel. And we know that there's been a lot of these industrial commodities over the last year or so. It hasn't been a straight line higher here, but we have headlines that are causing the energy sector to stay bid, and crude in particular to break out. Walk us through what you're seeing and how you think it plays out.
Sure. So if you think about it, just for lack of a better word, we have these words value growth. Of course, that's ridiculous. Everyone who's buying something think it's worth something more later on, otherwise you wouldn't buy it. But we have that nomenclature. And all value was working, growth was in trouble. But then steel, aluminum, you saw Alcoa, Nucor, all dropping 20, 30%, banks. And the only thing that has resisted the selling pressure, even staples, of course, defensive, has been energy. And the question now, though, is energy's relative performance to the S&P basically so wide on a rolling 3-6 month basis that it implies some mean reversion? That's ultimately my premise. I think we're full. Energy stocks are well bid. Many of them absolute steep, but relative very steep. And so my hunch is that those the spike high when the war first started remains the peak for the commodity, and that the energy shares are better as trims, selling calls, taking some measures before, as they say, someone does it for you. Well, here's a chart. Look at this. This is actually, so again, ratio charts in the long short world, people are even beta neutral and dollar neutral. They spend a lot of time because you're trying to beat a benchmark or other competitors in the space. Now, this is simply taking the S&P 500 energy sector and its relative performance to the S&P, one divided by the other. And then I've put the 150-day moving average on that. Now, that is an arithmetic scale. Let's go to log scale. And we'll flip back and forth here. We're going to toggle. That's log. Let's go back to arithmetic. Now, there's the arithmetic. It would appear, if we start with arithmetic, that right now, way down there at the bottom in 2021, that yes, energy has been a massive underperformer. But what we're focusing on is how far above the 150-day moving average. One could say, well, it's nowhere as steep as it was in the peak in 2007. Well, go back now to log. We're farther above than ever. And the problem with that is that whenever you've gotten this far above or below, you mean revert. There's just kind of no way out of that. So let's drill down a little bit if we can. Let's look at some here and now charts of the same thing, same ratio. The next chart is I believe what we've got. All right, this is the Russell 2000. Now, this is perfect. Check this out. One could say there's no way the current reading is as extreme as that '07 peak. It is. It's more extreme. Check this out. Flip it over to log now. We are farther above the 150-day now than we were in '07. And just looking at that, if you didn't know what that was, and you were just looking at, there's a yellow line, which is some security. Could be a fixed income, could be a commodity, could be sushi, sneakers, could be Coke or Pepsi, and there's the moving average. Every time this security, forget what it is, has gotten so far below or above the 150, what happens? It mean reverts. Does it have to? Of course not. Am I making the bet that it will? You betcha. And we've got others, but
yeah. Well, let's take a step back for 1 second here, because I think it's really interesting. You know, you made the same call that Guy did back in March when crude oil went parabolic. You could have thrown a dart at kind of anything that was really that well correlated to crude oil and the way it had just kind of gone up 20 points in a straight line, and then you had that sort of mean reversion. But Carter, the way that crude oil has kind of worked its way up that uptrend over the last few months, that looks a bit different. Doesn't it feel a little bit different? Like it's kind of been building in a different way rather than just kind of that explosion to the upside.
Sure. Well, because it had the blow off. Now the question is, and this is the only question that matters: was the market at that moment, was it quite efficient in 6 sessions? And we'll look at crude at the end, pricing in everything that's coming out now.
Yeah.
So what happened? And just to be clear, it was a Friday, and crude WTI was trading at $90 a barrel. And 6 sessions later, Friday, February 20th to Monday, March 7th, crude went from $90 a barrel to $130. That's a 45% move, up $40 a barrel in 6 sessions. Now think about that. People are assessing, wait a minute, he's just crossed the border into Ukraine. Wait a minute, what will that mean? He's going to ultimately cut off the Gazprom. Ultimately, he's going to make you pay in rubles. Ultimately, this and ultimately that. The market, there's the crude oil. Are we going to take out that high? Right now, we have news that should be unbelievable, meaning all of Europe's going to get off of Russian oil. How come crude's not 190? The point is, it was priced in 6 sessions, 90 to 130. Look at we have Brent here too. So despite the fact that it's a good-looking chart, it's walk-long line, it's worked out of the wedge, do we take out those highs? I think the market, in its infinite wisdom, in 6 sessions, Brent went from 100 to 140. Think about that. In 6 sessions, it was all priced in, including then 3 months ago, ultimately, Europe's going to stop getting Russian gas. What would it take now? What news could come along now that's going to make it go back to those highs? This is a classic.
Yeah. Well, Carter, let's talk about this for a second. And again, we're not charting this. This is more just from a discussion standpoint. So the last time crude oil was trading at these levels, it was 2014 or so, right? And we know what happened. The dollar was rising. We started coming off ZERP and stopped QE and all that funny business, which is what we're doing now. And we saw crude oil over the next 2 years get more than cut in half. It's down 65% or so. And again, Guy would say a lot of different dynamics here, but especially if you want to draw it to, I guess, the energy stocks, when you think about the XLE, that we know 50% of that is Chevron, Exxon, and Schlumberger. And from the highs in 2014 to its lows in early 16, when crude was down 65%, the XLE was down about 50%. Okay. So here we are now with the XLE, again, made up of those 3 large stocks, 50% of it, has come a long way. I think it was low 20s in the throes of the pandemic in early 2020. And here we are at 90 or so. So when you're thinking about this relative, the S&P versus, let's say, the energy sector, is the XLE what you're focused on the flip side of that if you're playing for that mean reversion?
Sure. And remember, you can have energy go up and S&P go up, energy go up less, and the pair trade's working, right? So there's 1,000 different ways to get that result. But I would point out also, so here we are. We have big news, right? And the commodity is up big. S&P 400 right now, energy is down. Russell 2000 energy is down. Meaning it's a classic buy the rumor, sell the news, whatever adage or idiom you want. Yeah. How is it possible that that's all we've got? After news such as all of Europe is going to stop getting their oil from where they get their oil, oil should be up $40 a barrel.
Yep. Well, let's go back to this WTI chart in a second, also here, because to me, if this thing were to mean revert, and to your point, at this point, the mean reversion would be back to that uptrend. So let's say we're back at 108. Are you a buyer there as long as it holds that uptrend?
I think that's fair. I mean, that's as good a technique as any. We're at we just backed away from 120. You start printing, 105. You play for the bounce. There are two things. There are two subjects, right? Structurally, was that 6-day advance up 45%? Did that set the high? I believe that. And then tactically, okay, now let's make some money, because we're not sitting here running 10-year money and thinking about our allocation to energy and what does it mean in ESG, and the war ends at some point, or Putin dies, or whatever disease he has, who knows? But the point is, yes, if you trade down to 105, let's play it for a bounce.
Yep. All right, I got you. All right, that's really helpful. I mean, listen, if I'm trading crude, and Guy used to do it back in the day, but if I'm trading crude futures here, I might look for a play back to that kind of 110 level, but I might stop it, Carter, not too far from here, man, because if it were to break out, it might be making a beeline for that little circle that you had at those prior highs here. So
right, and then what you do to former high is big thing. That's why double tops are so important.
Yeah.
But I just find it interesting that you're kind of like, wow, with that kind of news, that's all you got.
Yeah. Well, I just mentioned that period in 2014, 15, when the dollar was going higher, when rates were going higher, and crude oil was getting hit. There was also some growth concerns back then in 15 and early 16 that kind of helped that trade along here. But the dollar was really an important kind of input to this whole equation. A week or two ago, you thought the dollar had gone too far, too fast. We're looking at the Dixie, the DXY, the US dollar index. We know 50% of that or so is the euro. Talk to me about the lines that I drew. Your 150 moving average is down there at 98. Mm-hmm. It's not far off of that kind of uptrend that it bounced, but it really did it just kind of widened a great deal at its highs just a couple weeks ago from trend. Talk to me about your call on the Dixie and kind of when you think enough is enough.
Right. So the 105 levels, what's key is that was a well-defined top from about 4 years ago, right? And it gets a little bit above that and then backs away. The question is, and it's hard to know, once you get a counter trend move, whether it's, for instance, BABA going up today, right, or Chinese shares, or in this case, a down move, a counter trend. The primary trend is up, that's incontestable, and we now have a counter trend move. How far do they last? That's what moving averages are for. Some people use a short term like a 50. But your lines are great. And what it shows is that there's the real trend would suggest that this can go down towards 100. And here's why I would say that. Because remember, every day that you go out to the right, that trend line is rising. And so I think ultimately 199 is kind of where the Dixie comes to rest.
All right, so let's talk about this one. Guy Adami, if you're back with us here, let's talk about gold a little bit here, because this is one where it was kind of interesting how it kind of decoupled from Bitcoin a little bit when it seemed like, the Bitcoin, couldn't catch a bid, making new 52-week lows a little bit. But gold right now, Guy, is really contending with a couple technical spots. Carter can weigh in on that. I was just curious, your correlations with gold and Bitcoin. We're looking at Bitcoin in a second here. And what do you think some of the catalysts might be for it to kind of hold at these key technical levels, and why you'd want to play for a bounce higher?
Yeah, and I apologize. I was having some sort of Wi-Fi issue. So I'll answer those questions. I think one of the reasons Bitcoin came off as precipitously as it did, and we've talked about, is the fact that the Fed got hawkish in November. I think that everybody's come to that conclusion. I think the recent rally is on the back of soft economic data, which leads people to believe maybe the Fed won't be as hawkish. I think that's the move from 25,500 to 32,000 in Bitcoin. In terms of gold, though, same dynamics are at work. I mean, it's just been treading water here. But to the earlier chart, the dollar chart, if the dollar starts to give up ground here in a meaningful way, to Carter's point, I think that headwind that's been there for gold will become a tailwind. So I still think the gold rally, well, I shouldn't say rally, I still think the potential for the gold rally is intact, and I'm going to stand by that, especially for whatever reason. If this Fed were to blink for whatever reason, or to think somehow inflation is under control, I think that will open the floodgates for gold.
Carter,
I'm with you on that. But first, let me say, I thought you were going to do something. This was like a surprise. You're doing a costume change. You're going to come back or a hat or something when you were off. But anyway, you're still in the same shirt. That was exciting there for a second. Anyway, I'm with you. I think, look, this is what the expression is. Benefit of the doubt is given. Is it at a great juncture? No, we know it held trend. If you look at the 5-year trend line, it's sort of muddling. It's what a pair of twos is. If I were long, I'd stay. Now, here and now, should we rush out and buy this versus maybe, FXI or BABA or something that's more timely? No, but I would hold in the proper sense of hold, not Wall Street wink, wink euphemism.
Yeah. All right. So what you just mentioned the term muddling here. This Bitcoin is having a little bit of a bounce today, but it really has been after that kind of breakdown just, a couple weeks ago, really banging around these lows, Carter, from 52 weeks ago here. We know there's a huge air pocket between like 30,000 and the low 20s. Quick take there. We just have a 1-year chart, but
yes, no,
again,
it's a perfect chart. And it's fighting for its life at a moment where it needs to, because you break here. My thinking is it breaks, and sometimes it's this kind of thing that ultimately is the setup for the break. But the thinking that somehow that's it, it's fixed, and this is going to go on and do a big rally, I'm just not in that camp.
All right. Well, that's it. I think we're all kind of in that camp a little bit. It seems like the bloom is off the rose with crypto just for the time being. And you could have said that at any point a couple other times over the last year and a half when it was trading at the same levels. And there were big rallies from those lows at some point also. So again, Guy, if you're with us, buddy, take us out. Carter, thanks a lot, bud.
Listen, I'm sorry, everyone. I apologize. I don't know what's going on. Unstable internet is the cause. Maybe there's something happening that I'm not aware of. But that's it for Market Call. I apologize. I'll much better tomorrow. By the way, tomorrow, Dan, you want to just sort of tease folks and let them know where we'll be?
Oh, yeah. You and I are on an early flight to Miami. We're going to be at the iConnections Digital Assets Conference. They are a sponsor of our podcast, along with CME of On the Tape podcast. So we're going to be down there doing a live market call. Danny Moses, our co-host of On the Tape, will also be down there with us. So definitely tune in live at 1 o'clock tomorrow. That's going to be a lot of fun in sunny Miami.
It will be. I want to thank Carter Braxtonworth, and you are both sexy and brilliant. And yes, I'm saying that. Yes, on live television. I want to thank our sponsor, CME Group, where risk meets opportunity. Obviously, thank you to Open Exchange for powering this. We'll see you tomorrow from the FLA, 1 p.m.
See ya.